Welcome to The Explainer. Today, we are putting Toyota Motor Corporation through the absolute ultimate valuation gauntlet. We're going to apply the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. I am seriously thrilled to walk you through this because there's just nothing quite like stripping away all the market noise and looking directly at the cold, hard numbers. As your investment analyst today, we are going straight to the source documents, SEC filings, the FY 2026 financial summary, and Alpha Query data to figure out exactly what this automotive titan is actually worth.
To figure out if Toyota is a true buy at $174.59, we'll run through a quick snapshot of the business, apply the Buffett, Lynch, and Graham lenses, run a discounted cash flow valuation, test a couple of extra valuation models, and then wrap it all up with a definitive final recommendation.
All right, Part 1, Snapshot of Toyota Motor.
Straight from their official SEC filings, Toyota is moving a literally monumental amount of capital. We are talking a staggering 50.68 trillion yen in sales revenue for FY 2026. But it wasn't a totally perfect ride. Net income actually took a slight dip down to 3.84 trillion yen. Why? Well, they've been facing some serious US tariff pressures, plus they are pouring a ton of cash into human resources and future technologies. It's a very classic picture of a mature business. Massive top-line cash generation, but facing some real margin squeezes from external and transitional costs.
Moving right along to Part 2, the Warren Buffett lens.
So does Toyota have that massive economic moat Buffett loves? Absolutely. They passed the qualitative moat test with flying colors. We're looking at insane global scale and rock-solid product competitiveness. Plus, the refreshed leadership structure, led by new CEO Kenta Kon and Chairman Akio Toyoda, is being completely honest about the challenges ahead. They're heavily backing a 1.52 trillion yen R&D budget focused squarely on electrification and software-defined vehicles. Now, you might hear about their 43.2 trillion yen debt load and think, whoa, that's high. But wait, stack that up against their 105.5 trillion yen in total assets. For a capital-heavy automaker that also runs a massive financial services arm, that debt is highly manageable.
But you know Buffett, right? He doesn't just want a good story. He wants to know exactly how much cash he can actually pull out of the business. To calculate his favorite owner earnings, we take their massive operating cash flow, that's 5.47 trillion yen, and subtract the 2.39 trillion yen in capital expenditures required to just keep the lights on and transition to EVs. That leaves us with just over 3 trillion yen, or roughly 20.5 billion US dollars in pure owner earnings. That is a total cash-generating machine.
Here is the catch, though. Buffett demands a really strict margin of safety. Because the global auto industry is so incredibly cyclical and capital-intensive, his criteria would realistically trigger a buy closer to the $140 range. So, at today's premium price of $174.59, it's just a little too rich for the Oracle of Omaha's blood.
Let's pivot to Part 3, the Lynch and Graham lenses.
First up is Peter Lynch. He would instantly tag Toyota as a stalwart, a huge, mature company offering stability and reliable dividends. Now, since our source data doesn't explicitly hand us a definitive future growth rate for the entire business, we have to make a smart assumption here. We're going to peg it at a mature, conservative 5% growth rate. Using a price-to-earnings multiple of 8.95, that gives us a PEG ratio, price-to-earnings divided by growth, of 1.79. Honestly, that's a bit high for Lynch. He usually wants PEG closer to 1. But there is a silver lining he would absolutely love: their massive 3.65 trillion yen share buyback program. Gobbling up shares off the market is exactly the kind of management flex Lynch cheers for in a stalwart.
Okay, time for Benjamin Graham's notoriously strict defensive investor checklist. Toyota easily checks the boxes for adequate size, earning stability, and a really strong dividend record. It even cruises past the PE test with a stellar 8.95 based on Alpha Query's 1949 earnings per share. But then, it hits a brick wall. It spectacularly fails the price-to-book test. Graham demands a PB under 1.5. Toyota's current $174 price completely dwarfs its calculated book value of roughly $20.41 per share. That gives us a massive PB ratio of around 8.5.
And this brilliantly illustrates the brutal math behind Graham's famous formula. You take the square root of 22.5 times the EPS of 1949 times the book value of $20.41. When you run those numbers, it spits out a pretty harsh intrinsic value of just $94.62 per share. Graham's model absolutely punishes companies trading at high price-to-book multiples.
So the takeaway here? Graham wouldn't touch this stock right now. Not a chance. As the ultimate deep value investor, he'd demand a severe margin of safety well below that $94 intrinsic value line before he'd even dream of initiating a position.
All right, part 4, discounted cash flow valuation.
Discounting cash flows can sound super intimidating, but it really just boils down to 3 logical steps. 1, we forecast the free cash flows for the next several years. 2, we calculate the company's terminal value at the end of that period. And 3, we discount all those future dollars back to what they're worth today using the weighted average cost of capital, or WACC. That's basically the minimum return the company has to earn to keep its investors happy.
Now, our source data doesn't explicitly hand us Toyota's internal WACC, so we need to plug in a highly educated assumption to fill the gap. We're going to use a standard automotive WACC of 8%, along with a completely normal 2% terminal growth rate for a mature industrial player. That combination lands us at a base case fair value of roughly $185 per share. But notice how wildly sensitive this valuation is. If their cost of capital ticks up to just 9%, that value drops incredibly fast.
Part 5. Additional stock valuation models. Pulling in some data from stock events, Toyota is currently offering a very juicy 3.44% dividend yield. That's an annual payout of $6 per share. And the crucial thing to understand here is that this isn't some temporary fluke. It's heavily backed by their stated corporate policy to deliver stable, consistently rising dividends to their shareholders. Because of that dividend reliability, we can run a dividend discount model. Assuming a modest 5% dividend growth rate against an 8% cost of equity, the model suggests a $200 fair value. Or we could just keep it super simple. If we apply a historically normal 10x price-to-earnings multiple to their very strong 1949 EPS, we get a surprisingly similar valuation of $194.90. Both of these alternative models actually suggest the stock still has some decent room to run.
Finally, part 6, synthesis and final recommendation.
Synthesizing everything we've just uncovered really shows you why brilliant investors can look at the exact same data and completely disagree. Deep value purists using Graham's strict formula would absolutely balk at the current price. But when you look at modern cash flow models, historical multiples, and dividend models, they all suggest Toyota is actually slightly undervalued right now compared to its $174.59 trading price.
Ultimately, making an investment in Toyota comes down to balancing 2 totally competing realities. On the strength side of the scale, you have literally $25.5 billion in owner earnings, a rock-solid dividend yield, and incredibly aggressive share buybacks. But on the risk side, you're buying a stock with a really high price-to-book ratio, one that's staring down massive, unavoidable capital expenditures to fund this insanely expensive transition to electrified and software-defined vehicles, not to mention persistent, unpredictable U.S. tariff pressures.
So blending all of these guru insights and models together, our final recommendation as an investment analyst is a hold. The stock is trading pretty much right at its intrinsic value for a mature automaker based on cash flows. That makes it a fantastic, solid hold for income investors who are loving that dividend. But it just lacks that deep margin of safety required to make it a table-pounding buy for deploying fresh capital right now.
I am going to leave you to ponder this final thought. As Toyota spends billions on solid-state batteries and AI mobility, literally reinventing its entire product line for a post-combustion world, are these traditional, backward-looking valuation frameworks completely missing the future value of the world's largest automaker? Think about that. Thanks for joining me on this explainer. Keep analyzing, and I'll see you on the next one.